good improvement in all our businesses on all fronts, and it's both on the demand side of our business and in many areas also in terms of pricing. We've had to deal with a lot of input cost pressure, but despite that, our results have improved quite significantly. I think they're sustainable across the board, but they're very much different variables affecting our businesses, both division-wise and also geographical-wise. And the main issues here are input costs and currency plays, which differs quite significantly for all our business.
Well, let's take a look at it, because for now, I mean, the demand and so sales and prices have been beneficial to the bottom line across the board, but a lot of the turnaround is based on internal efficiencies that you've managed to put through. With sales volumes picking up, though, the concern surrounds just where you've cut. Are we looking at fat being cut off the business, or a little bit of muscle that could hamper growth moving forward?
No, I feel very confident that we've not cut into the muscle. I think in a manufacturing environment, there's always further improvements that one can do. And we're looking at efficiencies. We're looking at the way we deliver our product. We're looking at the recipes in terms of how we manufacture. And we've not cut into our resources in terms of human capital, but more so in the way we do our business.
In terms of capacity, we've had these results highlight that mills are currently operating at full capacity. When it comes to capex spend moving forward and actually bulking up, you've mentioned before that you're limiting capex spend to essential items only. Where will those investments be made, and to what extent, given the new demand capacity balance?
Yes, most of our mills are running either at full capacity or close to it. In many areas where we've got to concentrate on is further improving the margins rather than volume. But now that our results are starting to improve and we're bringing our debt down, we will continue to further improve our balance sheet ratios and to further reduce our debt. But certainly, we're also starting to look at where we can expand our business for future growth and improved returns. And the areas in which we will be spending for increased capacity or new capacity would certainly be in those areas where our margins are higher and where we're operating in growth markets or selling into growth markets.
Let's take a look at that debt position, because last year you said you're looking to bring it down to below $2 billion over the next 3 years. How's that going?
I think that's gone very well, and we've brought our debt down to about $2.2 billion, way ahead of 2012, which we said we wanted to be below $2 billion. And I think if everything goes according to plan, our debt level should be below $2 billion by the end of 2011 financial year, way in advance of where we thought we would be. However, that's still a high level. And depending on our profitability and depending on future growth opportunities, we would continue to try and reduce and work hard to reduce that debt. But it's not only about debt, it is about the various ratios in terms of liquidity, in terms of interest cover, and it's a combination of those that we would certainly be watching very carefully in our decision making going forward.
Let's hone in on South African operations, and in South Africa it's really hard not to talk about the rand strength, where levels affect exports and then your local selling prices as well. It affects you more so as an exporter, with 85% of turnover coming from foreign currency. How has it come to bear on the business?
Yes, the very strong rand and some volatility that we've experienced in that, but mostly the strength of the rand, has negatively impacted on our business. At Cycle, which is our highest margin business historically, we've had high volumes and high pulp prices, but the margins have been negatively affected by the very strong rand. We were fortunate in that the demand and pricing for pulp remained high in dollar terms, but the net effect here was negative rand-wise. And also, as you rightfully said, affected our local sales in terms of pricing, as imports are more competitive.
Taking a look at how you're working to mitigate against some of those losses moving forward, I mean, what are some of the measures you're putting in place to actually, mitigate against that risk, where we are looking at the case of a rand staying stronger for longer?
Yeah. Well, luckily there are no losses, but it is a squeeze on margins. What we need to do is ensure that in terms of our export businesses, that we sell into markets where demand is strong, and as a result of demand being strong, that the dollar prices at least would be high. That's on the revenue side of our business. On the cost side, we need to continue to find ways of further reducing our input costs and to increase our efficiencies. In the domestic market, it's about service, it's about quality of product, and it's also about being more efficient and reducing our costs so that our customers prefer to buy our product rather than an import on the basis of service, consistency and reliability.
This in a context where you've still got, pushing higher prices through a very big challenge. You've managed to successfully do it in Europe, and you're saying, that should help restore margins moving forward. You've effectively done it there. What's your ability looking like to do that in South Africa?
I think we've got a very good track record of being able to increase prices. On the back of service, on the back of very good relationships with our customers, and on the back of providing a good product.
Yeah. Are we looking at a consolidation to achieve more pricing power, gaining traction even more so than we've seen in the past?
In Europe, we hope to see further consolidation for particularly coated mechanical paper. In South Africa, we don't foresee any major consolidation, and certainly we're not planning any at this point in time.
Forecasting a better year ahead compared to last year, what's the outlook looking like?
Yes, we've had a good year compared to the previous year, but we've got some way to go. So we're expecting our business to further improve going forward, depending on what happens in the world economy. But we're positive that Sappi will continue to improve its performance in all aspects.